On the television show Parks and Rec, the anti establishment character Ron Swanson invests his life savings in gold and buries it around his property. Investing in gold is a punchline. It's today's version of hiding your money in a mattress. It's what you do if you don't trust the financial system, only it really isn't. Precious metals has become a key component to balanced investing and retirement planning. Today, we have the pleasure of speaking with Greg Allen himself, the founder of Allen House Metals. Allen House Metals is a precious metals dealer specializing in gold, silver, and platinum. They offer a comprehensive solution for buying, selling, and securely storing precious metals with a strong focus on supporting investments within IRAs and retirement accounts. The company prides itself on transparent pricing, customer service, and providing both a seamless e-commerce platform and personalized support from retirement specialists. They also have a financial literacy program to educate people on how to avoid scams, as well as the best way to invest in precious metals. But before we begin, I'd just like to say that this video is not sponsored by Allen House, and we are not giving investment advice. The purpose of today's conversation is to just better understand precious metals investing, and we want to get it from the horse's mouth, so to speak. So welcome, Greg. It's nice to have you with us today.
Thanks for having me on, Jonathan. Really excited to kind of get down to brass tacks and, give people more information on the world of precious metals.
Well, so in my intro, I talked about Ron Swanson and the punchline of just buying gold, hoarding gold. There's this sense that if you're kind of in that gold or you're buying precious metals, you're not really a serious investor. You're someone who's kind of hiding from the markets rather than participating in them. So let's start with the first obvious question. Is that true? Is it not true? And why are people investing in silver and gold?
So I think it's a fantastic question. One thing to look at is purchasing physical gold and physical precious metals has changed greatly just over the last 10 years, right? A lot of people know of Investopedia, for instance. They have a lot of great information out there for investors. And if you looked back even 10 years ago, of accredited investors they surveyed, the number was only 7 to 10% that were holding physical precious metals in their portfolios. As of last surveyed, which is in the last 6 months, over 30% of accredited investors are currently holding physical precious metals, primarily gold and silver in their portfolios. The average allocation, according to them, is in the neighborhood of 20 to 30% on average. So it's really becoming mainstream, right? And one of the things we see that makes it mainstream is we're in a decade right now of what they call a broader commodity market boom, so to speak, right? Commodities are anti-dollar trades, specifically gold and silver, right? Meaning as the dollar loses value, they gain value, and vice versa. If the dollar were to gain value, they would to lose value, right? And we know every fiat currency in history has failed. Now, this isn't doom and gloom saying, the dollar's going to zero tomorrow. But I think if we were to ask 10 people, you'd be surprised if out of the 10, all of them didn't say they felt like their dollar wasn't buying them as much as it was 10 years ago, right? And so really the main reason we see people buying gold and silver at first, it's diversification. But as you delve deeper into it, it's an anti-dollar trade, right? People want to protect their assets and really preserve their purchasing power. And so it's that age-old adage, you never want to have all your eggs in one basket. Diversification is a key to success. So a few of the reasons we see people buying gold and silver is one, they're scared of a potential correction or crash in the stock market, right? As you get older and closer to retirement age, it's not saying the stock market won't come back, but you might not have the time to wait for it to come back if you're right near retirement, right? Other reasons is, people, if they're holding cash is losing value. If you had 100,000 in a savings account in 2020, it's only purchasing you roughly $70,000 now when we factor in inflation, right? And at the same time, if you put that into precious metals, in gold since March of 2020, we've well over doubled. We're almost near tripling now. And in silver, we're now over triple where we were there. So it's really to offset risk and it's a diversification play overall, if that makes sense.
Is it a hedge against inflation or is it something different?
It is a hedge against inflation, right? One thing to remember, right? Because is people overcomplicate. I find a lot of analysts will overcomplicate the play in gold and silver, right? And at the end of the day, there's two things that we know to be true in gold and silver. They are guaranteed to hold their intrinsic value, right? They're not going to go to zero. And the other thing is they rise in value with the cost of living. Okay. And so the easiest way to look at this is if you were to buy a house 100 years ago, let's just say, for rough numbers, a house cost you $1,000 100 years ago. And at the same time, you bought $1,000 worth of gold. Well, let's say the average house today in America, let's just say is 400,000 for rough numbers, right? The theory in that gold rises with the cost of living is that same $1,000 in gold you bought 100 years ago would buy you the same house today. And in fact, gold has actually far outpaced inflation. If you had bought roughly about $200 worth of gold instead of the $1,000 house, it would buy you the same house today.
You're not suggesting that, hey, go all in on gold,
No,
avoid stocks. It's a way of balancing. You're doing different things with those investments.
100%. And I think, one thing to keep in mind is it's a different psychology than investing in stocks, so to speak. It's a store of value, right? And so one thing investors need to remember is by definition, buying gold or buying silver is the safest thing you can do because of the fact they hold intrinsic value, right? That doesn't mean they're never going to have a correction or never going to go down. What it does mean, though, is if they do go down, all you have to do is hold the asset and wait for it to come back. It's not, it's not like GameStop rather play where, you see a short squeeze or a pump and dump and, you're holding it and it never comes back, right? Ultimately, it's one of those where we see investors almost set it and forget it, right? They're allocating a portion of their portfolio to precious metals as a safety play, and that's something that they let ride over a long period of time. There are great studies, like for instance, CPM Group did a 50-year study from 1968 to 2018, trying to ascertain what is the best portfolio allocation that will allow investors to thrive in all times, right? So this is, in stock market booms as well as recessions and this type of thing. And ultimately, they came up with a mix of physical assets, gold and silver, T-bills and bonds, as well as the S&P 500. And their study showed investors that had between 25 and 30% of physical gold in their portfolio yielded on average 9.7% a year over a 50-year period. So it's an asset that it's not just performing in doom and gloom periods, right? It's performing in down markets and up markets, even though sometimes it's like watching grass grow.
It's not for the white knuckle guys who want to trade, buy and sell every day.
Yeah, like listen, there's better ways to get rich quick. It's definitely not a get rich quick scheme. But if you want something that's stable, that is going to consistently return you decent percentages, and something that you can hold either yourself or in a facility that's outside the financial system, it's the number one asset to hold.
So what I think is interesting about your mentioning of the store of value, right? It's a really effective way to store value. In the last, 80, 90 years, with the US dollar being the reserve currency, that's where most of the world has kind of stored value. When they need to kind of protect against their own personal economy, their own national economies or whatnot, they buy US dollars and they buy US bonds. It feels like there's a shift right now where there's a little less trust in the long-term value of the US dollar. And I'm not suggesting that you're a currency expert, but when you talk about the storing of value, it feels like we might have maybe fewer options than we did 25 years ago, where the US dollar was one of the most stable, ways to secure value. And now maybe not so much.
So I'm really glad you brought that up because we don't want to get. I don't want to give a whole currency explanation to everyone here, and we leave this the video more confused than we got into it, right? But when you look at it, one thing that's become apparent, and this is over the last two administrations, is countries specifically are holding much less in terms of treasury bills and US debt. And so ultimately, what that does is our dollar loses value, but also they're flocking to other instruments to be able to store their own value in terms of their country reserves. And so, a statistic for you right now in 2024, 25% of all gold was purchased by the Chinese central bank. That was not the case 5 and 10 years ago, right? We have to remember gold is being purchased by central banks at record levels right now. And the reason is if we go back and look historically at this, right? In 71, Nixon ended Bretton Woods, which was not the gold standard. That's what Roosevelt ended. It was a gold exchange system, right? Since then, the US dollar was set as reserve currency because of the petrodollar, right? Countries were paying for oil in US dollars. Well, that's not happening anymore, right? China is paying for oil in yuan, and they also actually are paying for oil in gold at times. You have Russia, who's buying both gold and silver, and they're trading that and rubles for oil. And so really what it's done is it's destabilized certain safety instruments to investing, right? A great example of how this has changed the landscape is, for the last 25 years, a lot of the banks, Bank of America primarily, has suggested a 60-40 portfolio, right? 60% of your money in stocks, 40% in bonds. If you were to go on Google right now and Google it, Bank of America and several other banks have been coming out since November and said that 40% should not be in bonds anymore. It should, in fact, be in commodities. Not gold specifically, right? You can smatter that 40% between gold, silver, other physical commodities too. And the reason is because they're outperforming bonds, right? We're in a similar situation when you look at I know inflation numbers are coming down, but if you look at what happened through the 70s, right, we're in a kind of strange situation like that. Not necessarily stagflation at this point yet, but really what the Fed's done is they've handcuffed investors. And that's because we have tariffs right now. And so they're not willing to cut interest rates to bail out the stock market and these other paper investments because the uncertainty caused by tariffs. But then at the same token, these elevated interest rates are causing a lot of investors a lot of harm when it comes to the fact that they're paying higher yields on everything, right? Like the institutions are leveraged everywhere. They're using leverage. So leverage is much more expensive. And the concern becomes, well, hey, we know the Fed has come out and said they're going to be cutting rates. They've delayed it till September because of the tariffs. We know if Trump had it his way, interest rates would be at zero today. And so the concern then becomes, okay, if rates are falling, yields follow. So your bonds aren't going to be performing. And the other thing we know is if rates are falling, the yield on the dollar is falling as well. So the value of the dollar is falling, so to speak. And so this means, bonds aren't a great investment over at least the next 3 years. Whereas, for precious metals, the sky is the limit in terms of a low rate environment. If we look at how gold and silver have done during interest rate cutting cycles since 2000, there have been 3 to 4 major interest rate cutting cycles. The average return in silver during an interest rate cut cycle is actually 413%. The average return in gold, it's not as much, but it's 245%. And so, again, this isn't saying, sell the farm and sell all your stocks and go into metals, because that's not good for anybody. But it's definitely a fantastic move for a specific percentage of your portfolio.
Yeah, I'm glad you mentioned that what we're not saying is go all in on gold, right? I mean, it would be easy for you, given your business, to tell people to do that. Give us the reason why we're not going all in on gold, or why it wouldn't be wise, or what are the risks that we have to consider when you're buying commodities specifically?
So I think, I'm going to cite that CPM group study again, because they actually had a risk versus reward curve in their study. And it's not saying that you won't make more of a return on average if you have more gold in your portfolio. What it is saying, though, traditionally riskier investments, stocks, even stuff, real estate, for instance, which we know can be subject to yields. Those investments that are riskier tend to have short-term payoffs for taking that risk. And so, if you had 75% of your portfolio in gold, over a 50-year period, you would have made a bigger return than if you had all of your money in the S&P 500, according to that study. But where you would have lost out is the potential chances, for instance, on an IPO, or for instance, on a tech stock, where you can double your money in a year, right? And that's not saying that happens every day, but it's one of those things where you can earn higher returns in certain riskier investments. Look at Nvidia, right? I know Nvidia is down right now with everything going on in the tariffs, but you could have made 10,000% in like 6 or 7 years, right? And so that's not something that happened in gold. I think the other thing to keep in mind too, especially as we get close at or near retirement age, 100% of your money in anything is dangerous, because you're starting to need to take money out of what you've contributed for all these years. And so if you have all your money in a single asset class, if that asset class has a short-term correction and you need funds, you're really getting hammered, right? And so that's where the diversification comes into play, right? There used to be the permanent portfolio, where it was 25% in stocks, 25% in bonds, 25% in commodities, 25% in cash, or an asset that's like cash. And so if you look at that, the reason they were suggesting that is, well, let's say we have a stock market correction. You have 3 other asset classes you can pull funds from that aren't losing money, and wait for it to come back. Let's say you have a short-term correction in the gold market. Again, 3 other asset classes. And so that's why it's also the point we make to investors. One thing I hear all the time is, oh yeah, I'm diversified, from someone who's dealing with, let's say Schwab or Fidelity. And the one thing to keep in mind is, a lot of people say this, but all of their assets are in the stock market, even though they're smattered against, different types of companies. And so the thing to keep in mind is, how could you, be truly diversified if 100% of your investment dollars are in one market instrument? That doesn't matter, even if it's, GLD or SLV, which are an exchange traded fund in metals, right? No matter what, we don't recommend putting 100% in anything. You know what I mean? So really, it's spreading that money around and making sure you're protecting yourself for all situations.
One of the most interesting things that I think you said there was this idea that over a 50-year time horizon, over a 50-year time horizon, gold is really, really effective. But you and I don't really live on a 50-year time horizon, right? No. Most of us aren't going to, if we make an investment right now, it's not a 50-year time horizon for us to expect that. And to your point, the movement of stocks and how they move is more short term. Even if we want that long-term horizon on stocks, like 10 years and whatnot, you do well. It goes back to this idea that if you are only investing on one time horizon, then you can't control when that money's available when you need it. But if you're hedging against different asset classes, then you have a better option of having the money that you need available when you need it, rather than, well, 50 years from now, I could get out that money and I'd be wealthy. Well, what good is that going to do me when I'm long dead?
And I think this is the thing. I had a conversation with a longtime client of mine yesterday who's 80 years old now. And we were talking about these 50-year studies. And, one thing he's looking at right now, and he's frustrated, is, the beauty of the internet age and the age we're in right now is the data and the information that we have. And so, one thing that we were talking about is looking at these same 50-year studies. The other thing they show is in stocks specifically, if you pick individual stocks, individual companies, as opposed to the portion of your money being in the S&P 500, you returned over 100% less picking individual stocks than you would have in the S&P 500. But then at the same time, since 2000, if you missed the 6 best trading days in the S&P 500, you would be down by over 100% compared to someone that just left their money in there and let it ride. And so the other thing we were talking about is this allocation of, S&P 500, precious metals, and having either a little bit of cash on hand or another type of physical commodity or an asset like real estate. And he was saying, I'm kicking myself wishing I knew this in the 70s because I would have been doing this all along. And the fact of the matter is, this information wasn't out there, right? These 50-year studies started in 68, 69, 70, and 71. We only got this information over the last 5 to 7 years, right? And so really the biggest thing we try to educate investors on is at the end of the day, we want to take all emotion out of it. We want to look at the data and look at the charts and make our decision based on facts and not emotion. And whenever you're able to do that and use the wealth of information that we have at our fingertips now, you're never going to be hurt, right? It's when we let emotions and these things creep in that things can get a little hairy and money can be lost.
Yeah. So, all right, let's get down to brass tacks. As far as I know, I can't drive down to the local Walmart and buy myself some gold. There's not a gold store in which I can go get something. And so you're talking about a physical asset, right? That's very different than a lot of the stuff that we buy and sell in terms of investments now. In fact, on stocks, I don't even get a certificate anymore when I buy a stock, right? I don't have anything physical to talk about, but gold is the ultimate, or silver is the ultimate physical thing. So how do you go about buying gold and silver?
So I think the first thing is you have to establish, hey, where do I want to make this investment? Not in terms of where physically, but in what type of instrument, right? Because you can do it with cash money, as in money that's not in a retirement account, or you can do it with money that's in a retirement account. Once you make that decision, rather, it's a really simple process, right? And so let's say an investor was going to try and purchase one of these with money in a retirement account. The one additional complexity that adds in is the IRS does not allow you to take physical delivery of the asset if it's in your IRA. And so you need a depository, a registered depository that holds the asset, right? What we try to do in terms of the IRA business is we want to be a one-stop shop. So we handle the physical asset. We educate the investor on, number one, what product should we be buying? Because ultimately, we're not collecting here, right? We want to buy the product that we're getting what we're paying for. We're not paying some crazy premium, right? Then next, we actually have depository locations in Dallas, Texas, in Delaware, as well as up in Canada, which doesn't work for IRA purposes. But we have those depository locations that are in the same building as our distribution facilities where we would ship you the metal from. And so it makes the time to deposit and liquidate very quick because there's no shipping needed, right? Once that metal's in the depository, the nice thing is you actually have a login through our program called Vault Direct, just like you would a Fidelitrade account or, a Schwab account. You can check your asset online at any time. You're able to buy, sell, and everything with the click of a button. Now, if we say, hey, I don't want to use my IRA, I want to buy it in cash dollars, there's two decisions you have to make. The first one is, do I want to keep this at home or do I want to store it? Now, in today's day and age, you could fit $50,000 worth of gold in a sock in your underwear drawer. You know what I mean? Silver's a little bit of a different story. It's not hard to store, but It's more volume, so to speak. And so what I find with investors is a lot of the time when we creep above that $25,000 mark, they're saying, "Hey, can I store this somewhere? I don't necessarily want this at home," not just because of the storage, but also the insurance risks, right? So we handle storage. But if an investor buys in cash, even if they store it, if they want it at home, we ship FedEx 48-hour delivery fully insured. And so at the end of the day, you can check out via e-commerce site on our website, and we accept, ACH, check, bank wire, credit card. We're actually, to my knowledge, the only website in the world that can process a credit card transaction for precious metals above $75,000. So we make it real seamless. And just on this topic, I do want to hit basically what we're trying to do here is allow investors to buy physical metal like they were buying an ETF on their phone. We want you to be able to click a button once you make your decision of how we're going to buy it, and the transaction's done. You have no more work to do. And so that's something we've done in the last 5 years that, before people would think otherwise about buying physical products. They're like, well, there's a lot of moving parts and I need a bunch of different people. So really, to streamline the answer, figuring out your purchase type. Once that's done, we either store it, ship it to your front door, and we handle everything.
So people do talk about this idea of the physical gold purchasing versus an ETF. Define what ETF is, what it stands for, and how you can distinguish between kind of why one is better than the other, if they are.
So an ETF is an exchange traded fund. The most popular in gold and silver are GLD and SLV. And now the thing is to be frank, if we were talking in 2016, most investors would probably buy the ETF over buying the physical product just for sake of ease, right? The key change that happened, aside from companies like us streamlining the process to buy physical gold and silver, the key change that happened was right after the pandemic in 2020. The prospectus of GLD and SLV changed. SLV, I believe, was on page 7 if you wanted to look it up. And so during COVID and even now, we were in a major supply crunch for gold and silver. And so what a fund, an exchange traded fund, would do in GLD or SLV is the value of the fund would track the price of gold and silver, because what they would do is units were purchased, meaning as an investor like you or I would buy units in the fund, they would back the fund with physical metal. And so it was a way to have the gold and silver exposure without the extra moving parts. The issue is during that supply crunch, they changed their prospectus. So A, they no longer have to back the fund or purchase any physical metal to back the fund. And B, they gave themselves a way out in that they could liquidate the fund at any time without investor approval and give the investor liquidation value. Now, just to give you an example of how this changed things, right? In 1 year afterwards, if we look at SLV, from, valley to peak, meaning bottom of the market to top of the market, physical metal outperformed the ETF by over 38%. And the reason for that is twofold. What these funds discovered is, as they didn't have to back the fund with physical metal anymore, well, hey, why are we paying to store this metal? We can increase our profit share if what we do is start selling off our physical metal as the prices are going up, and we keep selling units in the fund. So they ultimately stopped tracking the physical metals markets as closely. And so what you have is, in that 1 year period, you have that huge discrepancy in SLV and silver. But really, when you think about it, if the fund isn't backed by the physical asset, what makes the fund go up and down? Volume, purchases in the fund, right? So sure, people seek safety in gold and silver when there's turbulence in the market. So you still will see it go up. But if you track it over the last 5 years, it's going up nowhere near as much as physical metal. And when it comes down, it really comes down a lot.
That's really interesting. It almost makes you wonder, well, what are you actually buying? Like this idea of gold rather than
Yeah.
the actual gold.
And that's exactly it, right? And so the last thing I would say on the ETF issue, the biggest roadblock people would have to buying physical metal before this was liquidity. Because one thing an investor that buys stocks doesn't think about is, well, how do I sell it? Because why would you, right? You buy a stock, you sell a stock. It's real easy. And so that's why a lot of people would buy the ETF. The thing is, in our industry, there are a lot of companies that will sell you gold and silver. But when you go to sell it back to them, I've heard every story in the book. I don't want to, name companies and call companies out, but we've gotten a lot of clients because they've said to us, well, hey, I bought $500,000 worth of gold and silver and this company told me to put it on eBay, which, is crazy, right? And so liquidity, if whether you use us or anyone else, there's no skin off my back, but you want to make sure you're liquid. And so really the biggest thing we've done to dissuade people from buying the ETF and deal with us is we guarantee liquidity to all of our investors. We guarantee we buy everything back. But additionally, we help investors who have dealt with these companies that, aren't the most legitimate and tell them to put it on eBay. We buy that product back for them as well. Really, the process to sell, and I bring it up because, I don't want people going blindly through the night and not thinking about the liquidity process, right? If you have metal stored, and this is another reason why people will store metal as opposed to taking delivery. If you have metal stored, we typically try to have it as T plus 2 to 3 business days. Meaning, if you tell me to sell on a Monday, we want to have money to you by Wednesday, Thursday, 2 to 3 business days after that money, the transaction. If you have metal at home, it's not that it takes longer. It's just you've got to get the metal back to us. And so, if you have priority overnight shipping, it's the same amount of time to liquidate as it would be if you were going to store it. But if you're going to deal with another dealer, you need to make sure you're liquid, and you need to make sure you're asking those questions of, not only how do I sell, will you buy it back? And what are your fees to do with a buyback? Because, it with a physical commodity, these are questions you need to make sure you know before you jump in head first.
Just out of curiosity, what does that look like? Are they literally gold bars? Is there gold of different quality? Am I buying the commemorative coins that can be melted down? Is there additional value stored in the format that the gold is in? What does that look like?
So that's a loaded question. Like we could we could sit down here and talk for the next 2 hours if you let me ramble and go into it. But what we specialize in is what's called investor bars. Okay. And these are, typically speaking, these are 10-ounce and kilo bars of gold and platinum and kilo and 100-ounce bars of silver. All of these bars we don't sell anything that's not LBMA or COMEX approved. Okay. LBMA is the largest bullion market in the world. It's in London, England. COMEX is our market centered in New York. Okay. And what that means is we're not selling any products that are minted in Bob's basement in Pahokee, Florida. These are all bars that will have a mint mark on them, serial numbers on them. A lot of them will even have a hologram on the back with a QR code, which allows you to verify that they're authentic. And so the big thing about these products, like I was saying earlier, if you're buying physical gold, we want to buy the product that we're getting what we pay for. In other words, we want to pay the smallest premium we possibly can when we buy it. And we want to make sure when we sell it, that it retains that value, so we're not taking a massive haircut. And so you mentioned coins, right? If anyone listening to this takes one thing away from this video, one thing, I really hope it's that you don't buy coins. Don't buy collector coins. If you hear a grade, MS69, MS70, if you hear the word proof, don't buy it. If you're collecting something, there's nothing wrong with collecting gold or silver. But if you're investing, there's no point in paying this extra premium. And so I'll say it, in this sense, right? When you think of a physical product, the more workmanship or craftsmanship that goes into that product, the higher a premium you're going to pay. And so if we talk about a bar, you think about the process, they're going to pour the liquid ore into a mold and stamp the number on it. It's easy. So it has a very thin premium, right? Above that, you have what would be called a round. For most people, if you haven't dealt in gold and silver, it looks like a coin. It's just a little less intricate, right? It'll have a slightly higher premium than a bar. Now, above a round, you have a coin. A lot of people have heard of, an American eagle or a Canadian maple leaf. The coins are more intricate in the sense they even have laser engravings that's only visible by a loop so that you can see that it's authentic. But that comes with a price. And then above that, we have graded collector coins, or we have things like proof coins, right? And the ultimate thing in our industry is a lot of these companies do what's called a bait and switch. So people will buy gold and silver because they say, hey, it's a non-reporting asset. It's outside the financial system. And these companies will say, well, hey, if you buy a coin pre-1964 that's graded in a collector's item, it's non-taxable. Well, take a second and think about it. The whole reason you were looking to get in the industry is because it's a non-reporting industry. And then you're getting bait and switch by this. And so to sum this up, if you buy a collector coin, you'll see the premiums on these average between 70 and 300%. Now, that's not at the wholesale level. That's at the retail level, right? These companies are pulling the wool over people's eyes. When you go to sell that back to them, they're not going to pay you any more than they would pay you for a bar of gold. And so what you realize is, I've had customers, unfortunately, we've almost become a specialist in helping people out of these situations. But, I've had customers who, put $100,000 into gold proof coins and the market's doubled. And, I get a call from them because they find out they're getting offered, $2,000 more than they originally paid. And they're like, what happened? Again, if you learn one thing from this, do not buy a collector or a proof coin. You don't know what you're getting into. Stick to bullion. It's not that an American eagle, by the way, or a Canadian maple leaf is a bad product. Those are decent coins. But again, not proof, not collectible. If you're going to buy in a smaller quantity, those coins are okay. No, you're going to pay more than a bar, but you're not going to pay that collector value. Don't get fooled. Don't buy the collector item.
Well, what's fascinating about that is the way to maybe think about it is if you're buying a commodity, the more work that is done to turn that commodity into something that you buy, the less it becomes a commodity, right? The whole point of a commodity is it is the very essence of what the thing is, so that you're buying that and not all the add-ons that you would normally buy if you were trying to buy a silver fork. Right? That's not buying silver as a commodity. That's buying a fork. And if you're buying a coin, you're buying a coin, not necessarily just the silver.
Exactly. And, the thing is, most people don't know this stuff, right? They reach out to these companies thinking they're, with rose-colored glasses, thinking that everybody is a fiduciary and is, there to do right by them. And the sad thing when it comes to physical commodities is there are some bad actors there. And so the one thing I would encourage you to do, part of that comes with, how do I sell it, right? Because when you ask these companies off the get-go, how do I sell it? And, what am I getting on the sell for this product? You'll find 99% of them can't give you a direct answer. And that should be a red flag right from the get-go, right? They're okay. Appreciate your time. Thank you. And on to the next.
Yeah. Well, this has been a fascinating conversation, and I am sure, and I would love to maybe have future conversations, but we do probably need to respect both your time and not necessarily make a 4-hour video, even though we could. It sounds like it's a very complicated topic, and we really appreciate you helping to kind of unpack it a little bit, because I think for a lot of people, it's either a shadowy industry or it's overly simplified and they don't really understand how it should fit into an investment portfolio. And I think too many people don't actually think of it as an investment so much as a way to opt out of traditional investing, which is not what you should look at it as.
Yeah, 100%. But, 20 years ago, that was the industry, right? This has become a lot more mainstream as we've lost those options. And, again, I really appreciate you having me on. As I'm sure everybody watching this can tell, I can ramble here for hours and hours and hours, right? But I'd love to come back on when you have a chance, because I think it's one of those with a few moving parts. There's different things that can go into it. And, the biggest thing is education here. The more people know, the better they can protect themselves.
Absolutely. Well, great. Thank you very much. Appreciate having you on.
Awesome. Thanks, Jonathan.